As you guys know, I'm currently on a 2-week break from live trading as I learn and implement my new ICT strategy. In this video, I'm going to take you through the 3 key takeaways from this first week of, taking a break from live trading, as well as a high-level overview of what my current trading plan looks like, because until I started to sort of approach the different concepts in a very structured way, it was all just very confusing and hard to implement. Finally, I'll take a look at Euro USD from this past week and illustrate these 3 concepts, as well as a few others, just based on how my trading plan is structured. So as you guys can see, the 3 main sort of takeaways from this week, or at least the 3 that I'm starting to focus on, because while there are a lot of important concepts, there's a few that are recommended you kind of start with, because that gives you a good sort of foundational understanding of the strategy itself. And so those 3 are fair value gaps and time, which I think is probably one of the most important, but you can't use time alone, which is a bit of a catch-22. And then there's obviously the trading plan. So just diving into structure, basically what it is, simply highs and lows. And the key is knowing which highs and which lows to use. This is easier said than done, because for a long sort of time, I've associated structure with close below a high or close below a low, higher highs, higher lows, lower lows, lower highs. But starting to learn that it's not that simple. You can have a close below, a previous high or a low, and that doesn't necessarily constitute a shift of structure. And so, while structure is foundationally very important, because it is the foundation of any trading strategy. Any trader you sort of come across will mention structure to some degree. I think how structure is viewed or how it's implemented is a whole different sort of game. How I'm looking at implementing structure, I basically look at manipulation, displacement, focusing on the impulse structure, and then there's a bit on premium and discount, which I'll come to. So manipulation and displacement is basically looking at the momentum. Manipulation legs typically fail to displace or push rapidly beyond structure, and this tends to signal reversal or shift in structure that's imminent. Price will usually be manipulated below a low or above a high for trades in its true intended direction. And this is what I was kind of mentioning about price can close above a high or a low, but not necessarily mean that that structure continuing in that direction. It could be a manipulation depending on the volume of price at that point. Displacement, as the word says, displaces or pushes rapidly beyond structure. The signal's continuation. Displacement, or some may know it better as imbalance, is a sort of key indication that price has strong conviction to continue in that direction. And displacement is pretty important, especially when we get to fair value gaps. Impulse structure. So this basically says that not all structures created equal, and we should only focus on the structure that is considered to be an current impulse. This is the structure that forms displacement and fair value gaps. And so we don't, just pay attention to any structure that isn't an impulse structure, essentially. So there will be corrective structures and there'll be impulse structures. We're patient in the corrective structures, because we're trying to time the impulse structures, but then once obviously we get into the impulse structures, then we tend to be more aggressive in pulling the trigger and executing on trades. All trends come to an end, and there is a way to gauge when trends are likely to return. This can be done by premium and discount. And so basically a simple way of looking at premium and discount is basically the 50% fib retracement, which I used to use in my trading, but didn't think about it as premium or discount. And so, for example, if your sentiment is short and you're looking to sell, you want to sell at a premium, and inversely, if your bias is long and you want to buy, you want to buy at a discount. And how we identify those levels is essentially plotting the 50% or the flip tool, which only has a 50% level on an impulse leg. And they're going back to the theory of premium or discount. Once price gets below that 50% leg in an uptrend, price is then in a discounted area or at its fair market value. And inversely, once price trades above that 50% level, price is then at a premium or its fair market value. So that in a nutshell is structure. Yeah, a lot of key takeaways from there. And if you guys are wondering, all these notes were taken from Casper SMC's full ICT strategy video. That's on YouTube. If you want to check that out, yeah, I literally got all these notes from there. So all the concepts as well, I'm learning from him. So yeah, let's move on. Fair value gaps, what are they? They are 3 candle formations with an expansive middle candle that forms a gap between the wick of candle 1 and candle 3. If this all sounds confusing, just sit with it a bit. I'll illustrate it shortly in the mistrade video that I'm about to go through. These show displacement in the market and the desire to continue to a further market, to a further target. And they can be used from anything from high time frame levels, directional bias, trade entries, and stop losses. And they literally can. And not all fair value gaps are the same. Some have a higher probability than others. And basically characterize them into 2 groups. There's either one-sided fair value gaps, which are high probability, and then 2-sided fair value gaps, which are a lower probability. And yeah, I'll show them in a bit. Why do we use these? They show displacements. Displacement is confirmed with fair value gaps, and they basically indicate how the market reacts to highs and lows, which pretty much informs, I guess, your overall bias. And then how do we implement them? Internal range, external range liquidity. Price is always moving to high, low, or a fair value gap, essentially. So external range liquidity is our highs and lows. So if price is forming higher highs, higher lows, our higher highs will be our external range liquidity. And then our higher lows will be the pullback into internal range liquidity before we continue to our external range liquidity. Low time frame tells you when the move begins, and the market usually reverses when we don't have fair value gaps. So the absence of fair value gaps, which is also the absence of volume in a move, can indicate that we are either decelerating or are pending a shift in structure. So yeah, it goes back to, you can really use them for a whole host of things, from a key level to trade from, but then also to inform that high time frame bias based on if you can identify them or not. And then market maker models are always present, and I'll go through this in a bit. One of the concepts, but it's got a whole story on its own. Consistency theory, this is where we come to one-sided and two-sided candle fair value gaps. So one-sided, we've got consistent candles, they're all in the same direction, all 3 candlesticks. If it's a bullish fair value gap, all 3 candlesticks will be bullish. This shows displacement, which means they have a high probability of continuing. And inversely, in this two-sided fair value gaps are indecisive candles. They're not all in the same direction. For example, bullish fair value gap, first candle closes bearish, second and third close bullish. This is a two-sided, as there is there's a combination of bullish and bearish candlesticks. They're not all in one direction. This indicates a bit of a lack of displacement, which means there's potentially a low probability of continuing. Break and structure gaps and inverse fair value gaps. These are a bit more, I'd say, niche, but a bit more advanced concepts. And we'll come back to inverted fair value gaps when we get to the entry criteria. But it's basically when a fair value gap is, what's the one before, is inverted, or price closes beyond a fair value gap, which signals a reversal. And then a break of structure gap is basically where we have structure, but then the structure is broken. And as we break the structure, we then form a fair value gap. So yeah, those are those two. So that in a nutshell are fair value gaps. We'll look at it a bit more in a second. And then time. This is what I've basically been looking at implementing from a quarterly theory perspective, longer than I have been looking at the ICT strategy as a whole. But it's basically the analysis traders can perform using time. Why is it important? Well, it helps us in deciding when to look for certain behaviors in price, which levels to trade from, and when to expect expansion or consolidation. It really is the backbone of how to put anything together in a trading plan. And looking back at my first backtesting session, I didn't incorporate time in that session, and I confused myself beyond belief. It just didn't make sense when I wasn't factoring in when things were happening, because it becomes hard to sort of filter out the false signals when you just looking for a confluence of all these concepts at any random point in time. So I think time really helps you frame strategy, and really, I don't know, just adds a whole level of structure that's hard to sort of put in words unless you like actually implementing it. But again, show you that in a sec. So how's it implemented? Time-based liquidity, which is new. That's either previous, quarter high or low, weekly, daily, session, high or low. Time is fractal, so it applies across the pretty wide spectrum. We look at opening prices. This goes back to the true open. There's a true daily open, weekly open, session open, and that's normally the beginning of the second quarter of any cycle. So yeah, you can look at how that works. And then the power of three. This is accumulation, manipulation, distribution in a nutshell. It's a concept that smart money positions themselves in the wick of the candle, and so that's where we ideally look to take entries. So we look to buy below or sell above the opening price of the candle. For example, if your daily bias is bearish and the market forms a wick to the downside, then this is an indicator that your bias may be incorrect, because if we're wicking to the downside, your bias is bearish. More likely than not, we're going to expand to the upside, and vice versa. So it basically tells us when to trade based on these three sort of phases below. And that, again, is something I've been sort of explaining for a while. So putting it all together in the trading plan, basically there's three sections of this. There's the bias analysis. I don't move to my entry checklist unless my bias analysis confirms that there's a valid setup. And then there's obviously the risk management, which kind of filters into everything. Risk management is not only position sizing, but trade management, both when in trades and once trades have closed, when I've won a trade, when I've lost a trade, what days to trade. That will be informed by, I think, my data over time. But I think risk management goes into a lot more than, people currently think it does. So from bias analysis, essentially looking at either weekly analysis from internal range liquidity to external range liquidity, or candlestick bias. Both, this also goes for the daily. And a key thing to note is I don't have to have both. I can either have solid confirmation of price moving from internal range liquidity to external range liquidity, or a weekly candlestick that sort of indicates what direction the next candlestick is going to expand in, which then can inform, my daily or even 4-hour bias. Once I've done that higher time frame analysis, either weekly, daily, and I've got sentiment there, then I'm looking for my H4 or H1 market maker models. And again, I'll look at these a bit more on the chart. Once I've got those market maker models, confirm this minute 15 or minute 5 external to internal range liquidity, which is basically structure. And then also monitor how price to opening prices or liquidity. And then also note something I have been doing in any case is just paying attention to high impact news events. I don't trade news, but I know that based off the time frames that I execute positions, I need to be mindful of when high impact news does occur, because there's a lot of volume at that time, and I don't want to be stopped out just for price to hit in my direction just because I didn't time my entry in accordance with when that news announcement was going to be released. And so that's the bias analysis. I need that to sort of align before I move to my entry checklist, which is, this is a checklist. Basically look at these sections on their own before getting to the lower time frame confirmation. I need 2 of these before I get down into my lower time frame confirmation, for which then I'll take 1 of these confirmations as, pulling the trigger. And then, this basically just speaks to my risk management and trade management, which is how I target positions. And basically can't check this unless my bias analysis confirms this valid setup. So that is essentially those are the 3 concepts that I think were the biggest takeaways for me this week. And let's look at how we can kind of make sense of this on the charts. So looking at EURUSD, how it unfolded during the week and what positions there potentially were. Look, disclaimer, the positions I'm going to show you here were profitable positions. It won't always be that way. I did identify 1 trade on pound JPY, which would have been a break even. But I think just in terms of how many confluences there were on this EURUSD positions, it was just a much cleaner example than the pound JPY position. So starting on the weekly, nothing much on the weekly. I'm sure if I wanted to read it in between the lines, I could, but it's, I don't want to force anything. So just starting on the daily, which I think is more than clean enough. We've got these, there was a shift of structure here, and then we've got that lower high, lower low, and then that break of structure was essentially our external range liquidity being met, and then we were trading higher into internal range liquidity. So we do have higher time frame structure. Even within this larger daily sort of structure, there is internal structure that's forming higher highs, higher lows. Then obviously that break structure to the upside, and then that internal range liquidity there. So that's kind of showing us that we, from this high point, are trading lower. And so while from this perspective, it's more of a correction, I think high time frame takes precedence, and a combination of those 2 indicates bearish sort of bias. We have the daily, and then we drop down to the 1 hour based on how our time frames align. And look, while I could just use the 1 hour here to look for, because there is a market maker model here, I just want to go to the 4 hour because this is just added confluence in that we then got our sort of 4 hour internal range liquidity to external range liquidity. We had this break of structure here to the downside, and then we were trading towards internal range liquidity. So we were in between these 2 points here, and we had obviously internal range liquidity in that area there. What I did then was very minimal fair value gaps, or ones that had not been mitigated or inverted. And so plotted an order block, which is POI, just at the top of structure. And this is actually where we came to. So we had a key level that had been achieved in terms of the order block. Our high time frame aligned with our low time frame. So we've kind of already ticked off 2 things on our sort of from a bias analysis perspective. Dropping down into the 1 hour, this is just added confluence now. And the more confluences we can stack, I'm just finding the better. But looking at our hourly, we also have a market maker model. This is one thing I'm still trying to wrap my head around. So if it's not 100% clear. But basically, we look for at least 2 consolidations that lead up to a reversal. And then once we get the reversal, there's an entry opportunity at the point at which structure shifted, which is a low, sort of low risk entry, because we at that sort of extreme point. You'll find out very quickly if your bias is right or wrong. And then there's an expansion or displacement in the intended direction after that first entry opportunity, which is where we get another consolidation, and then our second high probability trade sort of opportunity, which is slightly more advanced, normally tougher to get into. But the market usually displaces quite heavily after this. And so if we run through that, once we had breached this range liquidity and go to the bottom of that, we had first consolidation, displaced to the upside, second consolidation, here, second consolidation there, then another expansion to the upside, and then up there, and was an entry opportunity there, and then we had our displacement to the downside, and second consolidation, and then displacement to the downside. So 2 consolidations, reversal, displacement lower, consolidation, reversal. So we also now have a 1 hour model. And so now we can look for sort of entry confirmation. If we jump down to the lower time frames, but there was even more sort of confluence on this, just starting on minute 15. So that's obviously just a POI. And a rule of thumb I kind of have is if price fails to close above the POI or the order block on the time frame that it was formed, then it's still valid. We saw 4 hour to close, even though this manipulated above there and did close above. But yeah, we essentially had that consolidation. This was after the true open now. And then we shifted to the downside. And then, to be honest, we could have just had a sell limit at that point there. We put it at about 40 pips just to give it room to breathe. And then TP, time-based liquidity, minimum 2R. This was our weekly low at the point, but it's also technically our weekly open. So I like that as a target. And then, that was 2.6R. So clean trade, look, not a high reward, but if you can get 2.6R consistently at least once a week, it's, plus minus 10R in a month. So that was the first trade, very clean. But if you wanted to, I think, refine this entry a bit more, because obviously we had the market structure shift here, low time frame market structure shift as we confirmed that entry. But if there was a sort of more refined entry, and this would have been on the low time frame, if we came down to minute 5, there was a fair value gap one-sided because we had bearish candle, and then another bearish candle that formed, and then we had obviously respected that. This was after the break of structure, so I wouldn't have to get in there. We came into this area, and then looking at, we've come into the area now, looking at the 1 minute chart for entry, it would have been the same sort of market structure shift type of entry in terms of run up to liquidity or manipulation, break of structure, and then 50% retracement would have been clean entry, and that would have been roughly the same sort of risk to reward. I think if we took it on the 1 minute time frame, then the stop wouldn't have been so high. We probably would have put it above this 5 minute or I think this was a minute 15 fair value gap. But that's a bit more of an advanced entry, and I probably would have stuck 15 interest sort of realistically. And then just looking at the second entry, and a bit of a rule of thumb is the first entry is going to be the easiest. Obviously a bit riskier, but low risk because you get sort of immediate confirmation whether your trade is going to play out or not, because you are at the top of that shift. And if you catch that, then you don't normally take the second one. Look, if it's on a different day, then you could. Or if you're not still holding, then it's obviously you just hold to it. But if you miss that, then you look for the second consolidation entry. What I like here was, okay, obviously we have our high time frame confirmation, high time frame equals low time frame, and then we have that 1 hour market maker model, we have the 4 hour order block. So we've got at least 2 confirmations there. So we can start to look for those low time frame confirmations now to pull the trigger. But again, there was a confluence here, 15-minute order block. We came into that. I like how we manipulated that to the upside before we started to displace lower. And then as we displayed lower, we started forming order blocks. Looking at the most recent order block form in this area here. And then again, jumping down to the 1 minute, we had, this was a different entry order or execution type. There was a market structure shift, but I would have entered this on the inverse fair value gap. So here was the fair value gap that forms the upside. And then we inverted that when we closed right there. And then I was taking that as a market order. And yeah, our target then would have been the 4 hour external range liquidity, one of those just there. And you can see that displaced quite aggressively after that. And that was about a 3.28%. So 2 very clean opportunities in the space of 1 week. I think this did play out late in that period. Yeah, about eventually goes down there. 2 very clean opportunities, space of 1 week, 3.28 plus 2.6. It's about, what's that, 5.8%, not mistaken. And so those are hopefully 2 relatively clear illustrations of some of the concepts I just shared. It's the implementations, taking, is the learning curve is a bit tougher than I anticipated. But I think once I sort of started taking a sequential approach to implementing things and stacking them in a way that makes sense, it becomes a lot clearer. Also taking this time, I think, to just test out certain concepts and not just rush into live trading is also giving me that sort of space and sort of relief from the pressure of having to successfully implement in a very short space of time. So while I'm still learning how to implement this new strategy, I'll be posting my analysis daily on both my TradingView account as well as Twitter. Both links to those accounts are in the description below. And I think that's going to give you guys a sort of real-time glimpse into how I'm incorporating these changes, and also going to give you, I think, a more detailed understanding of some of the other concepts that make up this new and exciting ICT strategy. So if you want to see more, check out my daily analysis sort of uploads. But if not, obviously, we'll be back on the live weekly analysis this coming Wednesday. So remember, guys, consistency is the choice you make when you start doing the things you know you should be doing day in and day out.